All right, we have more changes unfolding in the US financial system and around the globe, changes that have contagion risk spreading through markets as the VIX is hovering around 20 for the first time since the banking crisis, and this artificial ceiling that we've seen on yields for the last decade has finally been lifted. Fear is beginning to seep into investors' minds. You see it in these investment bank reports that we look at, fear that I haven't seen happen this bad in a long time, worse even than what happened 6 months ago during the banking turmoil. We're going to look at why this is happening, why portfolios are beginning to roll over, because there's a reason for all of this. Something that a lot of people have been saying will be uneventful is turning out to be anything but that. We'll also look at what just transpired in the swamp of Washington, D.C., as this is playing into the fear factor that we're seeing, keeping big money investors wary for what happens next. But before we get started, press the like button and subscribe. It's all I ask for in return for making these videos. It helps me out, and I appreciate your support. So the U.S. Congress, folks, the House of Representatives just lost their speaker. The Speaker of the House, the person who's third in line to the presidency, was just ousted, and according to him, will not run again for the speakership. Markets want certainty and consistency. So speaking from strictly an investor point of view, this is the opposite of what investors want, but it's also refreshing if you're a fiscal conservative. If you want the government to stop spending like drunken sailors and rein in the beast that is the federal government, and only one body is able to do that, has the power to do that, the Congress, a body that for decades has been scared of its own shadow, endlessly passing spending bill after spending bill, scared to piss off their donors or lose an election. It's that insanity that has led us to this point, over $33 trillion in debt and rising quickly. Exactly 15 days ago, our national debt passed $33 trillion for the first time ever. Well, since then, what do you think's happened? Has it stopped? Of course not. There is zero fiscal discipline in our government, folks. In a matter of 2 weeks, we've gone from $33 trillion to $33.4 trillion. $400 billion additional dollars borrowed, up $275 billion in a single day. That means that we're borrowing $32 billion a day right now, per day. That's $1 trillion a month, which is why McCarthy being ousted as speaker is a big deal. There's only 40 days left before the money runs out. That CR, the continuing resolution passed over the weekend, was a temporary stopgap. The debt ceiling crisis is far from over, and the Congress is speakerless at the moment, something that has larger ramifications than just U.S. politics. There's a bigger agenda at play here. Discussions behind the scenes are taking place right now, trying to decide what to do in the worst case scenario. And to the powers that be, the worst case scenario is corking the flow of money to fund the war in Ukraine, something that can shift the power dynamic across Europe and Asia, because without McCarthy, it's very likely that the next speaker could be a bit less sympathetic to the idea of continuing to approve billions of dollars of our money for this war. And even if he or she does support it, the same cohort that cornered McCarthy will likely do the same thing over again. Bottom line, the Ukraine war may be coming to an end. And this, along with the bond market puking for the last week, has the fear index off the charts, even worse than it was during the banking crisis 6 months ago. And the VIX is now back at levels that we haven't seen since Silicon Valley Bank failed. So what to do? What does this mean for markets? It means that the Goldilocks scenario is off the table, gone, and portfolios are positioning for exceptional volatility over the next few months. The Fed's been waiting for higher unemployment. The one thing that can really speed this entire process up, well, we saw last month possibly the beginning of that start, with the unemployment rate jumping from 3.4 to 3.8%. This is especially important to watch right now, and not just because the Fed's watching it, but because the labor market is fickle and unpredictable. The Fed has no control over how high it goes, and messing with it is never a good idea. It's like putting a tiger on a leash, a false sense of control, and it's entirely possible that it breaks. Something, by the way, that we may have just gotten a preview of what's coming, what we can expect, as the ADP employment report was released this morning, and it came in ice cold, folks. Expected to fall to only 150,000 new jobs created in September. Well, it plunged to only 89,000, the lowest new jobs added in almost 3 years. Here's what Bloomberg says. U.S. firms added 89,000 jobs, fewest since early 2021. U.S. companies added the fewest number of jobs since the start of 2021 in September, and pay growth slowed, pointing to a weakening labor demand in several industries. The figure trailed all estimates in a Bloomberg survey of economists. The report adds to evidence of a further moderation in the labor market, which has been instrumental in fueling consumer spending and therefore the entire economy. Some employers are scaling back hiring amid lingering inflation and higher borrowing costs. Here's what ADP's chief economist had to say about it. We are seeing a steepening decline in jobs this month. Additionally, we are seeing a steady decline in wages in the past 12 months. Firms with at least 500 employees cut 83,000 jobs last month, the second largest decline since early in the pandemic. And above all, the most telling indicator is what's happening in the bond market. In bond markets, we spoke about this in Monday's video, how bond traders and investors capitulated and began selling, and that hasn't stopped. It's only escalated. This imaginary top or cap that we've all been experiencing for the last year, where yields just can't seem to break out like they normally would, has been lifted. The toothpaste is out of the tube now, folks. There's no putting it back in, with catalyst after negative catalyst unfolding right now. It's the beginning of a downtrend in the econ data, folks. We have the 30-year fixed rate mortgage closing in now on 8%, averaging 7.74% this morning, something that we talked about happening months ago in Q4. Well, it's on track to happen now, likely to cross 8% before the end of the year. Here's what mortgage-backed securities look like right now. The principal driver of mortgage rates, look at just how cheap they are. They've been cheap all year and continuing to get cheaper. And it's funny because for the last few months, big portfolios have been jumping in the mix here, thinking that the bottom must be close, but it's getting worse. It's getting cheaper. They continue to get cheaper. The more investors choose not to buy our mortgages, by the way, like you see happening in this chart, the higher mortgage rates go. And not to mention, the gap in the risk premium hasn't closed yet either. There's at least another half point before we're back to normal. So 8% is not only in the cards, it's likely, more than likely to happen. Here's what Jamie Dimon, CEO of JP Morgan, said in an interview with Bloomberg yesterday. And as much as, some of you guys don't like him, realize he's one of only a handful of people that is in the know. He's one of those people that are always in the room, regardless of administration, which one's in power, Democrat or Republican. He is in the room. He said this. Take a listen.
Two things which are extraordinary today, which may have different outcomes, and think of them as storm clouds. We don't know if they're going to hit, when they're going to hit, what they're going to do. Okay, so I'm not predicting that, but I'll tell you what I worry about. So one is the fiscal money being spent is so big, largest in peacetime ever, America and kind of around the world, with already very high deficits. And QT we've never had.
So two big picture catalysts, he says, that he's watching. Two things that are making him nervous. First, the fiscal cliff that we're clearly and obviously walking toward. We showed this chart in the last video, but I'll show it again quickly. U.S. expenditures by percent of GDP, one of the highest in history. This is not the total amount of money, by the way, that we're spending. It's how much money we're spending compared to total U.S. GDP. Only at these levels 3 other times in history, each of which were during periods of great crises, World War II, great financial crisis, and the pandemic, of course. Well, why are we still trying to spend like it's 2020? There's no crisis right now, but we're still trying to pass a $6.7 trillion budget for what? For what reason? And second, QT, quantitative tightening, which is something that the Federal Reserve has never really done before. QE, quantitative easing, we've done, pumping out all those dollars, filling the financial system with so much liquidity that it's caused virtually every asset class to swell and blow up like a balloon. Well, we're now undoing that, trying to. Here's where we are so far. $1 trillion already burned off. but a whole lot more to go. So all of this uncertainty, stocks and bonds taking a beating, has more to do with QT than anything else. This is where QE began, right here, a concept that Ben Bernanke invented out of whole cloth, the worst thing to ever happen to our economy. And they actually gave that man the Nobel Prize in economics. Because of his handiwork, we are now straddled with this current mess and a whole lot more work to do. The Fed's only burned around $1 trillion so far, right? They want to get us back to pre-pandemic levels. So what do you think? What's the ride down gonna look like? Let me know in the comments. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.